Hey everyone, good afternoon and welcome to all of you in today's edition of Business and Banking Dialogue. I'm KK, your host and moderator for this show. Welcome everyone to the EPS channel or from your Facebook, Twitter and YouTube. So all the participants are welcome. Our topic of discussion today is COVID-19 opportunity for an expanded scope of governance. So we're going to talk today in length about governance, corporate governance, because with COVID-19 coming, the corporate governance has to undergo a massive change. You know, it's almost a 360 degrees change from a corporate governance from what we were used to. And so we're going to discuss that. It's going to be a very interesting discussion. And today we have none other than Mr. Khushroo Panthaky. He's a CA with over 35 years of experience and currently a non-executive director at Grant Thornton Advisory. Good afternoon, Khushroo, and welcome to EPS Business Dialogue show.
Good afternoon to you, KK, as well, and good afternoon to everybody over here. Indeed, a privilege.
Thank you, sir. Thanks for coming. Sir, we are reaching a milestone next week, and so you may have attended some of our shows. Could you give us briefly what do you think about the show?
I must say, I think they have been very informative. I think in this particular environment, which is basically supposed to be keeping the spirits of people very, very low, webinars of these kind indeed actually sort of lift up the spirits to a great extent. It gives a lot of knowledge to people, and also it gives them the ideas and of course the information by which the organizations continue to operate as a going concern. So I think I've heard a few, and I believe that there are more on the way, and keep up doing the good work. It's a great one.
Thank you, sir. Thank you for your encouragement. Thank you very much. Ladies and gentlemen, COVID-19 has created unique and very profound challenges for the board of directors and those charged with governance. We call it as TCWG, those charged with governance, overseeing short-term and long-term health of the corporation and its business prospects. Navigating the COVID-19 crisis requires careful consideration of a range of issues, these unprecedented circumstances. Some of the buzzwords you may have heard is recovery and renewal, or perhaps some of the buzzwords you heard, or you must also heard of survival, containment, and reboot or restart, some of the other buzzwords. But whatever the buzzwords are, in corporates, those charged with governance have to reinvent themselves quickly. So Mr. Panthaky, we have had black swans, last no one was 2008, 2009. So what's so different under the current COVID-19 era, which needs to be taken into consideration by those charged with governance while discharging their duties and responsibilities?
Good question, KK. So let me sort of put this particular topic in perspective. When we talk about governance, immediately the idea that strikes is, of course, the board of directors. But it's not just the board of directors which are the theme of governance. It's way beyond. And it includes the management to a great extent as well, because ultimately everybody is working together to ensure that the organizations continue, they are sustainable, and profitability is definitely given the fact that it ultimately leads to a shareholder's value. Now, once again, when we talk about governance, I think the inference that is being drawn in general is that it may relate to only the listed companies. I also believe that governance is required in the case of public interest entities, which may not be necessarily listed. And at the same time, I have seen quite a few organizations which are privately owned organizations. At least 20 to 25% of them these days have independent directors on the board. And they have started to talk about governance, given the fact that they are required to observe quite a few discipline measures to install good norms of functioning and, of course, building up governance measures as well. COVID-19, I do not want to get into what is COVID-19, etc. But to be honest, I think given the fact that many of these earlier speakers would have spoken about the impact of COVID-19, I think the responsibilities of those charged with governance under the current environment are very onerous and are very significant. Every independent director, every executive and a non-executive director, everybody who is on the board have become extremely serious under the current environment to see how this particular pandemic has impacted the financial performance of the company, the operations and the activities of the company, the way the things have been functioning in the past and what has changed in the current environment, the way the controls are operating, the way the cybersecurity is actually put to risk, and many, many other factors which have come up of late when these individuals keep on assessing the impact. So first of all, let me deep dive a little more into how these things need to be taken care of and who will be responsible. The buzz line in the listed corporate world is that the board of directors are responsible for the internal controls and internal checks within the organization. They have the ultimate responsibility. Although the management is initially responsible for the controls, ultimately the oversight of the board of directors make them responsible for the internal controls. I have always been an auditor, and I will talk more from that particular perspective as well. But the management needs to ensure that the controls are not flouted, that the controls are not compromised in this particular environment. One of the challenges initially, which I thought that we would be having as an audit firm, or maybe we would be having as individuals, would be how do we audit these organizations? But forget about the audit. I think more so from a perspective that how would management handle the financial reporting function under this particular environment? Come 15th of April or 20th of April, many organizations started to declare the results. And when they declared the results, let me tell you that none of them would have compromised in terms of what are the requirements of financial reporting. There is no leeway given by any regulator in terms of the fact that there is a practical difficulty, and therefore you can sort of manage in such a way that you declare the results and things move on. They need to do it. So first of all, what kind of IT controls had to be further enhanced? What kind of information technology modules had to be introduced within the organization to make sure that access of information by people who work from home, auditors, management, and other stakeholders are in a position to get such information? What is the kind of security levels to transmit such information from one location to the other? Thirdly, very, very importantly, what is the impact of this particular COVID on the financial enterprise, on its operations, on the functions, on the significant components? Most importantly, I think I must say that by the grace of God, this particular thing happened somewhere after the 15th of March, and therefore the impact on the revenue and the operations could be just for 15 days. But definitely now when we are coming into the first quarter, which is the 30th June quarter, the impact would be significant because many organizations have not even started their commercial activity. So definitely that is the future. But for the 31st March year end, impact has not been significant. Given the fact that what could be the impact, yes, there had been a reduction in the valuation of some of the investments, in the valuation of some of the securities which the company held as its investments. There were practical challenges in terms of physical verification of inventory. If the company has got multiple locations, those were the challenges as well for the companies to sort of do the physical verification and then the valuation of inventory. There were instances where, if at all, there are international branches, and in some locations, I must say that India was well geared from a corporate world perspective as well for an effective financial reporting. But there were many, many other countries which were not well geared. And therefore, the reporting of those countries back into India for preparation of consolidated financial statements itself was a challenge as such, given the fact that some of this were not even operating. Then the impact on some of the covenants, some of the contracts, and some of the arrangements that the company would have. What can be the changes in some of the terms of contract, and how does it impact the organization as such? Impact on the borrowings. The Reserve Bank of India actually came out and laid out a couple of announcements in terms of the fact that moratorium be given to the borrowers in terms of the payment convenience. So the banks which had, on financial institutions which had given loans to these individuals and to these corporates, actually extended it by 3 months. And now it is further extended by 3 months as well. So in short, what happens is that at one point of time, yes, the borrowers actually get that particular benefit and the facility, which is a relief. But you can imagine the cash flow of the lending institutions, because what was supposed to come 1 month ago, 2 months ago, 3 months ago, 6 months ago may come in bits and pieces, may not come. And therefore, there is always a particular delinquency risk for those organizations as well. So many, many factors to be considered. Most importantly, I think the responsibility of those charged with governance is the fact that whether the management has been able to assess the impact on all the functions, on all the activities of the company, whether they have been able to articulate that particular impact to the board. Did the board deep dive? And I think that's the buzzword again. Did the board deep dive into the discussions with the management to see, is this impact really the impact, or the impact could be much larger, or the impact could be much lesser as well. And given this particular impact for 31st of March being the year end, forget about that much. But what happens subsequently, what happens as of 30th June is another chapter that will be unfolded in the next few days as such. So the responsibilities of the boards are very onerous. They take it, that responsibility. They are also required to ascertain whether the company would continue to be a going concern a year down the line. Unfortunately, some of the sectors are very badly impacted. For example, the hotel industry, the hospitality, the restaurant and food chains, the airline industry, tourism, travel, etc. They are significantly impacted. And therefore, uncertainty will definitely loom over for a longer period of time. But then there are certain sectors which have also been sort of gaining on the opportunities that were available out of COVID. And I've always believed that wherever there is a problem, there can be opportunities as well. So this is a very, very strict assessment by the board to take up that particular responsibility of assessing the impact, seeing how it is being reported into them, working out the plans as to how those particular risks on account of this particular pandemic have been mitigated by the management, and to provide advice and guidance to the company and to its management in ensuring that the company continues to be a going concern, or wherever there is an issue, then those issues need to be addressed. So yes, I think it is a very, very large responsibility, and I'm sure that the corporates have now gained the experience for the very initial first financial reporting under this particular environment, and which will continue on a quarter-to-quarter basis as well.
Thank you, Khushroo. I mean, that was great to sum up the entire governance and the responsibility of the board of directors out there. The task of the board of directors is now much more than what was earlier. So, Khushroo, you are advisor to so many corporates, I'm sure. Yeah. So, attendance and holding board meetings is like a tick box to many of them, right? So, directors or the independent directors, they come, maybe they have some good dry fruits, and that's a tick box, nothing beyond that. How can board meetings become more responsible and directors are for active business participation, not for mere attendance and sitting fees? Is there something you can throw light on this?
Yeah, I must say that this is I think you have put me into a little sort of a real scenario, and maybe I'll answer this question very candidly as well.
Yes.
Let me go back to 20 years back, when corporate governance actually started to become the buzzword in the corporate world. And somewhere around 2001, 2002, the Kumar Mangalam Birla report actually came out on corporate governance, which was basically nothing but a much more improvement in terms of the Cadbury Committee report, etc. And from that particular point of time, corporate governance started to be there in substance and in form. Now, I have seen the corporates sort of transitioning the corporate governance over the last 20 plus years, given the fact that this came in early 2000, 2001. And I would sort of relate to what you said, that in the beginning, even my observation in some of the corporates, with due respect, in some of the corporates was that the directors were not in a position to sort of completely understand and appreciate the responsibilities. And they thought that coming to the board meeting, concurring with the views of the others, etc., could sort of be taken for granted. But I think things changed over the next 3-4 years. And I've seen the corporate governance building substantially over the last 10 to 15 years, substantially. The laws and regulations of our country have become very, very difficult currently. There have been punishments being inflicted upon those who have actually been defaulting. There are fines, penalties to corporates, to individuals. Companies Act actually have laid out significant penalties on those who default individually as well as corporates in terms of governance. So gone is the era where individuals used to come and have cashew nuts and peanuts in the board meetings. And I think now it's much more serious. To give you a small example, these days, the audit committees run into anywhere between 2 hours and 6 hours. Some of the audit committees run into the entire day, to be followed by the board meeting. And very, very importantly, the committees, first of all, need to be constituted in such a way that the relevant expertise has to be there in that particular committee. Now, for example, there is a central board, which is a board of directors. And the board then has got individual committees like, the audit committee, the nomination and the remuneration committee, the investment committee, the shareholders grievances committee. And these committees need to be chaired and need to be represented by individuals who are in a position to contribute to the effective functioning of these committees. More importantly, I would say from an audit committee standpoint, like, on an average, I attend at least 10 to 15 audit committee meetings every quarter on an average. And I have seen that the norms of governance have significantly risen. The independent directors are not shying away from asking very, very difficult questions to the promoters and to the others who are responsible for the day-to-day functioning of the organization. And at the same time, if at all there are individuals who are not in sync with some of the resolutions, then they abstain from voting on those particular resolutions. So individuals have started to be more inquisitive. They have started to resign where they are not very comfortable. And I think this is a great comfort to others who actually work along with the audit committee to enable strengthening the governance as well. So there was an era where the corporate governance was more informed, but I would say that to a great extent, the needle has moved, and now we see corporate governance both in form as well as in substance.
So has the needle also moved for independent directors? Every company has to have a couple of independent directors, and most of them are generally silent. So has the needle moved for them also?
I must say that independent directors are no longer silent. I must say that.
Yes,
and I have also seen that these days independent directors have been introduced on the boards after a proper evaluation by the nomination and the remuneration committee in terms of what is it that they would be in a position to contribute. So individual independent directors could be technocrats, could be chartered accountants, could be solicitors, and could be individuals with the government service experience in order to add value to the corporate enterprise. And these individuals have been, as I said, they have been interacting, for example, with the auditors, with the statutory auditors, with the internal auditors, and with some of the key management personnel as well within the company to gain understanding, to digest what is happening, and at the same time, giving them the advice and the guidance in terms of how the organization should be run. They have been spending much, much more time compared to what they used to be at some point of time.
Thank you. Thank you so much. Ladies and gentlemen, I continue to have discussion on the board directors governance or those people who are responsible for the governance. Please send in your questions early and we can take it across to Khushroo. You know how it is to be done. Put your questions in the Q&A box and I will get it across to Khushroo. Or if you wish to ask a question directly to Khushroo, you can do that also. Put up your hand and the back office will facilitate you to ask the question directly to Khushroo, and I'm sure Khushroo will be able to answer. But please be cognizant of the fact that Khushroo is running he's in a very sensitive position. Okay, he's a advisor to many corporates, so no naming any corporate, and please don't ask very sensitive questions. He may turn down some of the questions if it is too sensitive for him to answer. There cannot be a conflict of interest. So we continue our discussion, Khushroo. It's a golden opportunity for the corporate governance, perhaps to think differently than what they used to think so far. So it's a complete shift that is happening. Can you please elaborate on the assessment that needs to be made by the management of any enterprise while evaluating the degree of impact of COVID-19 on operations, activities, and more importantly, on the financial stability of the business?
Surely, KK. In fact, I go back to the very first question. So this is somewhat very much related to what
Yes.
I had mentioned earlier, but definitely I would like to throw more light on in detail about how this sort of, in terms of the assessment of the management, in terms of how the organizations would continue. So if you look at it, I think the panic today, and I use the word panic because everybody is thinking that, there is a pandemic and the organizations are going to go down the drain. Economy is down, this is there. I mean, stock markets are down, everything is down. And what's going to happen? I would say that we haven't experienced this kind of a pandemic and the world has not experienced this kind of a thing over the last 150, 200 years. So definitely this comes once in a lifetime. And everybody starts talking about the new normal. So when we talk about the new normal, why are we not giving space to ourselves and to the economy to breathe under this particular new normal and take its own course and evolve for the better? I have always been a very optimistic individual, and I personally believe that with every particular event, which is basically a failure, there is always a success attributed to it, and therefore you look at the opportunities as well. So out of this particular pandemic, what could be the opportunities? As I mentioned earlier, there are some sectors which will gain out of this particular thing. But even these organizations also need to have a deep dive as to where they are impacted. Are the orders not on hand currently? Are the pipelines going to be dried up in terms of incoming orders? Are we having a challenge in terms of having stock on hand? Are we in a position to review the activities and the control environment and the way the organizations have been operating in a manner where we take into consideration that this pandemic is going to be there and the impact is going to be there over the next 1 year? And how could I make it sustainable over the next couple of years, where I may not just focus on the profitability, but more on the going concern of the enterprise? Individuals who have supported me as my own staff in this particular organization, in a company, some of them have been working for 20 years, 25 years with all these organizations. How do I ensure by effective borrowings, how do I ensure through effective turnaround of working capital that I am in a position to pay them equally or maybe comparatively lesser? I must say that the corporate world has been pretty good. Not many of them have reduced the pay of individuals and salaries of individuals. Not many of them have thrown out some people. So corporate world has been considerate to that extent. Assessment of activities and the business and alternate plans need to be in place to make sure that the businesses continue as a going concern. Definitely, most important is, of course, a review of your cost structure. Wherever it is possible, today, if you look at it, I'm just giving examples. Today, if you look at it, would you need so many premises? Now, effectively, this is going to be the new norm where 50-60% of the people have elected to work from home. And even the corporates believe that in the overall interest, let them work from home. So would you need so much of premises? Can you not cut down on the premises? Can you not cut down on your outgoings? Can you not cut down on your travel expenditure? And travel expenditures, etc., are going to be very negligible. So on one hand, if at all the management is conscious about control of those costs, on the other hand, if at all they're conscious about churning out new avenues of sales and generating income, and of course, establishing the best of controls in a manner whereby the review of the business and the performance of the business is evaluated very closely with the board on a regular basis, I think organizations are here to sustain and organizations will continue to be a going concern. So yes, there will be a thorough evaluation, and that is where the experience and the guidance and the critical evaluation of the board and those charged with governance will hold a very, very significant place to run these enterprises in a manner which is perpetual.
Thank you, Khushroo. Thank you very much. Yeah, as you say, assessment of the activities and plan, and more about the cost structure. We did touch upon the fact that offices and premises, it's all consideration of so many companies. Some of the IT companies have already announced that more than 50% or 60% of the staff will work from home. So, the offices will be a question mark that will come, which will cut down the cost. Thanks for that. We did touch upon the moratorium that has been given by the government. And there is a debate going on whether it's good or bad. So we'll leave that aside. But moratorium allowed to repay the loans seems to be a good relief for the borrowers from a borrower's point of view, given that there is an additional time allowed. But what are the risk factors for these lenders who, how the developments would pan out for the lenders and the borrowers? Because suddenly they were expecting some, money coming by so and so time. Suddenly it's not there. So while it's good for the people in general who have taken the loans, but the lenders are in very deep difficulty. How are they going to adjust themselves?
Well, I think as far as you rightly mentioned, as far as the borrowers are concerned, it's a significant relief. Initially, it was a relief of 3 months, which has been further extended. And that comes as a big relief for them, given the fact that many of these organizations for whom these particular loans have been availed may not be in a position to start their business activities. And therefore, the cash flow is definitely a concern for the borrowers as such. Coming to the lenders, and I think RBI has stepped in as far as the lenders are concerned. And in the month of April and in the month of May, they came out with announcements on specifically how this particular moratorium process has to be run. And when this particular moratorium process is being run, these lenders have actually done a very detailed exercise in terms of who have availed this particular moratorium and what needs to be done in their accounting systems, in their financial reporting, insofar as insulating any risks arising out of delinquency are concerned. So RBI came out with the requirement that wherever there is a moratorium being taken into consideration, or wherever there is a moratorium granted, then there will be a requirement for these lenders to evaluate the impact. And they are required to make a particular percentage of provisioning for a potential NPA that may come up in the future. So given the fact that if under this particular moratorium, if somebody is not paying within the 90 days, it doesn't become an NPA. But at the same time, for 31st March year end, which was the cutoff, there was a 5% additional provision required on these advances, which were forming part of the moratorium. And RBI made a further announcement that there will be another 5% on the same moratorium individuals or the corporates who have availed the moratorium when the accounts are finalized for 30th June. So if you look at it, what is happening is that in a very phased manner, with this particular announcement of Reserve Bank of India, the lenders have already provided 5% and will provide another 5% as of 30th June. And generally, even for an NPA, for a substandard asset, the lenders normally provide 15%. Not wishing that everything is going to be an NPA, not at all. In fact, corporates will definitely come back and pay back to the lenders. But the risk of delinquency, if any, gets insulated to a great extent, which is definitely 10% as of now. And as and when there will be a financial reporting period and coming up in the future, there could be some more provisionings voluntarily also happening by these with these lenders evaluating what it could be and insulating the risks arising out of delinquency, if any. So yes, it has been insulated to a great extent, but definitely it creates a big cash flow issue in the event that these borrowers are not in a position to repay the loan on time. One is, of course, we talk about the willingness, where most of the borrowers are willing and are inclined to pay. But the other hand is, of course, the ability to prepay. And if at all the ability to repay is restricted, then definitely it will cause some kind of a temporary difficulty and maybe some kind of a temporary delinquency in the return of advances which the lenders have given. So it's a wait and watch. I would say that let's evaluate this over the next 6 months or so and see how things are improving and shaping up before we end up for 31st March 2021. But yes, these are difficult times for the lenders as well.
Okay, thanks. So I was at another online conference, and there was one interesting question out there. So while the EMI moratorium has been shifted, there has been, many of the corporates have also taken overdraft on their collaterals, right? And so there is interest that they have to pay based on the amount that they have borrowed from the credit limit that has been given to them. Now, there is no moratorium on the interest that has to be debited every month. So you have any thoughts on that?
You're absolutely right. I think the simple line in English is, of course, there is nothing like a free lunch. You know, in America, they say, let's go out for lunch, but there's no free lunch. There is always a purpose. If in America, your boss asks you that, would you like to come out for lunch? You would be definitely concerned about the fact that whether he's issuing a pink slip. So similarly over here, there is no free lunch. Here it means that interest will keep on accruing till such time under the moratorium period that the borrower would be repaying the loan. So interest will keep on accumulating. There is no moratorium in terms of non-payment of interest as such. So your principal can get deferred over a period of time, but because of the fact that the principal gets deferred, your interest liability on that particular principal will keep on accruing, and therefore it will balloon in a particular manner where you may pay after 6 months, or you may decide to repay beyond a particular period of time as such. So there is nothing like interest waiver, or there is nothing like an interest moratorium as such.
Okay. No, waiver is understood, but the deferment was the question. Should there be a deferment of the interest? Is the question. But anyway, thank you. I think that's like you said, there's no free lunch, so it can't be that you take everything and you don't get anything. So let's move to the role of internal audit, Khushroo. Yeah. So before I ask you that question, let me repeat to my audience. I hope the audience are able to enjoy this discussion. And please put in your questions as soon as possible. We don't want questions at the last minute because that will only delay our guest. So on the role of internal audit, that role is becoming very, very important. Okay, it is always important, but I think much more is getting enhanced. How can internal audit act as an effective tool in enabling TCWG, that is those people who are in charge of the governance, to determine and measure the impact of COVID-19?
A very, very good question. I'm happy that you asked me this question. Although I have played a very limited role as being an internal auditor, because my 80% of my experience comes from the statutory audits where I'm a partner. I would say that internal audit is a very, very effective control mechanism to give the comfort to the management and those charged with governance in terms of the controls and processes underlying an organization are concerned. Now, there are generally two kinds or three kinds of internal audit structures that are there today. One is definitely you see in some of these public sector organizations or public sector banks, etc., where the internal audit team is of individuals who are the employees of those organizations, being led also by somebody who is an employee of the organization and reporting into the audit committee. It definitely has its own strengths and demerits as well. Strengths in terms of the fact that they understand the business very well, they know individuals very well, they know exactly what's going on in the organization. Demerits to an extent that when you have a familiarity issue, you know your boss tries to overpower you at times, your boss tries to put you under a particular manner where you are sort of suppressed to write what you are required to write in the report. I think that may not serve the purpose. But generally what we have seen also is that in many organizations, and today in more than 75 to 80% of the corporate world, which is a listed corporate world, individual independent firms have been assigned the internal audit. An internal audit role is very, very different from a statutory audit role. An internal auditor is nothing but a part of the management, helping the management to make sure that the controls are strengthened, the systems are properly designed and they are operating effectively, and to come back with the recommendations wherever there are lapses in controls or where there are issues on compliances. Ideally, an internal auditor reports into the audit committee chair. I have seen many organizations where there is a dotted line for an internal auditor to report straight into the CFO or to the managing director of the company. And I always say that that is completely incorrect. He cannot report into the CFO. I'm sorry if at all there are some CFOs out here. He cannot report into the CFO. He cannot report into the managing director. I think that particular line of responsibility is only required from an administration standpoint and not from a governance standpoint. The audit committee chair should have a discussion with the head internal auditor or individual or the partner who is actually heading that particular internal audit from a professional firm. Internal audit is not just a transactional audit. To make it more effective, I think the audit should be process-based and should be control-based. So first of all, I'll just spend a couple of minutes so that people understand the importance of it. An internal auditor should understand the business environment, should understand the conditions in which the company is operating, should go deep down into the different processes of the company, understand what are the key controls, how these controls are designed, are they designed effectively, how these controls are operating, are they operating effectively, and how are the compliances being adhered to? Is the company compliance conscious or not compliance conscious? Now in India, normally if you see in any organization, there are 650 or 700 compliances to be followed. But what are those the large compliances that are required to be followed? If that evaluation is being done by an internal auditor on a regular basis, if the internal audit plan is approved by the internal audit plan gets approved by the audit committee, which is a committee of the board, if they approve the particular plan, which has got areas across various aspects of the organization and not just financial reporting, internal audit is not just confined to financial reporting, it has to be overall for the entire organization and for the entire processes as such. And if at all, very fearlessly, whoever is the head of internal audit, whether an insider or an outsider, if he's in a position to fearlessly come out and report those observations or non-compliances to the audit committee and measure the needle of the movement in terms of those compliances and implementation in the subsequent meetings in terms of implementation status and report those as well, I think internal audit plays a very, very important tool. It's very important to have a very good firm of an internal auditor or a very good team of an internal audit, because this is basically the backbone of good governance in an organization.
Absolutely, yeah. So I think the role of internal audit, is absolutely going to be really good. And I like what you pointed out, that internal audit, besides auditing financials, must also be auditing internal processes, because if these break down, then there could be cost, there could be compliance issues. And so that's a very important audit, I think, observation that you made. So Khushroo, we go further into our discussion. But like I said, there could be questions coming from the participants, which could be in the form of a Q&A question or from directly. And it can come from any source, could be from many other social media channels also. So I have the first question for you from Mr. Vikas Kushawa. His question to you is, how will the moratorium period can benefit small businesses or startups? And are there any provisions or concerns to fulfill in order to receive the benefits?
Good question. So I would say that I think currently the moratorium period, which is being extended to about 6 months or so, definitely gives an ease in terms of the cash flow. Companies which are not in a position to generate the cash flow are not required to pay back to the lenders as stipulated what they have been doing. Further announcements, I think, are in place and they will come out over a period of time. Very difficult to say as to what the impact could be 3 months or 6 months down the line. I think we are just into the 3rd month of this particular moratorium process, and there are further 3 months. And let us wait and watch, I would say. But people keep, I mean, with due respect, people keep talking about moratorium benefiting the micro, small, medium enterprises, moratorium benefiting individuals who have actually borrowed. But on the other side, I think my heart also goes out to the lenders. There are thousands and thousands of lenders in this particular country. And if at all the lenders are not in a position to get back their particular money, and if at all they have to borrow further, then we are actually putting them into a great financial difficulty. And the role of the Reserve Bank of India is to make sure that not just the borrowers, but also the lenders are sustainable over a period of time. So I think there will be some measures being announced maybe in the future in terms of how this particular process will evolve over the next few months or so.
Thank you, Vikas, for a very good question. And thanks, Khushroo, for answering that. So we talked about internal audit, we talked about financials. So one of the risk of, let's look at the risk of window dressing of financial results could be higher under the current environment, possible, okay, because there are losses. So people would want to, corporates may want to do something about it, where corporates are struggling to declare a healthy financial positions. As you know, we all corporates live on a quarter-to-quarter basis. You know, every quarter we have to show good results. So do you fear that some of the corporates may have to do some window dressing, and how can this be avoided?
Good question again, I must say, and you're putting me in the spot. But anyways, I'll answer this question as well. KK, generally, what has happened over the last few years, I think the message from the regulators is very, very clear that if at all any organization and the directors who are actually at the supreme of the organization and in charge of governance, if at all they are going to be conniving into any kind of a fraudulent activity, or if at all their oversight is weak, where they are not in a position to see what the management is doing. If the management is doing something and if the independent directors and the directors on the board do not have an oversight, very honestly, I would say that I have no mercy on them, because it may not be conniving, but it is actually sort of a blind eye where they are not in a position to smell out the rat and find out what's going on. So the primary responsibility of financial reporting lies with the management. Definitely, the management will be always under some kind of a pressure, given the fact that it may not be for the last 31st March, but coming as of 30th June and 30th September and the period so on and so forth. There will be a lot of pressure on the corporates in terms of reporting the results. I think my only guidance and suggestion to them is that the entire world knows at the moment that what kind of a difficult situation everybody is in. And if at all somebody is trying to cheat the world, or if somebody is trying to give a different picture that even under this particular environment, I'm doing great and better than what I have been doing, some of them will still continue doing in the genuine sense. But not having done that, and if at all they would want to report, I think they are calling for a very big risk as such. These days, there is an inspection of accounts, especially where financial services companies are concerned. Regulators are doing the inspection of accounts, whether it is RBI or whether it is IRDA. They actually get into financial reporting mode and actually see whether the financial statements provide a true and fair view or not. I would suggest that the board of directors should be very conscious about this particular risk, because this risk will be definitely on the higher side under the current environment. There should be adequate instructions going to the internal auditor to support the board in terms of the fact that the scope of the internal auditor should be defined in a manner where the work of the internal auditor will mitigate substantially the fraud risks, the window dressing risks, which normally a company may resort into under this kind of an environment. And therefore, the inquisitiveness and the deep diving of the independent directors and other directors in understanding how the company has performed and how it reflects into the financial reporting will be a very, very important aspect that they need to consider. And again, a heads up to my colleagues in the statutory audit world as well, that the fraud risk assessment and the impact of COVID assessment on the financial reporting need to be thoroughly evaluated. If required, I think you must appreciate that the government under this particular environment has extended this particular reporting of 31st March year-end results by 2 months. Ideally, the date under the normal circumstances is 30th May, but now it is 31st July. And if at any point of time the corporates are in a hurry to declare the results, and if the board or the auditors are not comfortable of having gained adequate comfort on the financial reporting and what has been the results, then definitely they need to be bold in terms of extending those deadlines and reporting within the extended deadlines rather than being aggressive and reporting in a hurry. So yes, there is a risk of window dressing, but everybody, including internal auditors, statutory auditors, board, management, need to be conscious about the current environment and accept the reality, bite the bullet, go on and work harder towards making sure that the organizations remain sustainable rather than reporting wrong results.
Okay, thanks. And that's a good way of looking at it and how responsible the board of directors should be to get to just not allow this kind of window dressing. So that's a good thought you gave us. So Khushroo, jokingly I tell to my friends, the worst purchase I've made in 2020 is buying a 2020 planner. Okay, that's my worst purchase that I have had. Now, since that 2020 is a bad year, it's a written off year, why not consider your thoughts? Why not look at the losses that that will happen in 2020? Why don't we leave it off the P&L and book it into balance sheet?
So I would on the lighter side, I would call it KK standards of accounting.
Okay.
On the lighter side. So KK, I think we need to respect the accounting standards internationally, as well as what we have in India for the listed companies, what we call as Ind AS, or the accounting framework, which is more aligned to the IFRS, is what companies in India, which are listed corporates, have adopted Ind AS as such.
Okay.
And there is no particular guidance internationally or currently in India which can allow the losses to be carried forward to the balance sheet. Of course, your losses or profits, whatever it is, ultimately becomes a carried forward balance to your balance sheet, because that basically sits into your retained earnings. However, it cannot sort of, preclude the fact that it should not be sitting into the P&L. As I keep reiterating that this can be an abnormal year, the next year could be again an abnormal year. The entire world has embraced this particular situation, and we are living our life in a different environment, and we have accepted the new normal. Now, when we have accepted the new normal, we continue with what has been the laws and the regulations. No, none of the laws and the regulations have to change. People may get some benefit, people may get some kind of stops, people may get some kind of extension of timelines, but these things cannot change the regulations, and typically accounting standards cannot be changed. Therefore, if at all there are losses, the readers, the stakeholders, the shareholders, everybody understands the difficult times. It is okay to report those losses. And I must somebody asked me a question the other day that, is it really possible to quantify the impact of the loss arising on account of COVID? Generally, and showing it as an extraordinary item or as an exceptional item. I would go with the kind of enterprise that is reporting these kind of losses. For example, in the case of a bank, specifically, the Reserve Bank of India has given a guidance in terms of what additional provision should be made for 31st of March and 30th of June in terms of the loans where moratorium has been availed, where such provisions are made at 5% and 5% of the amounts borrowed at each reporting period. Now, that is something that can be easily quantified and can be shown separately. But it cannot be possible to really find out what is the impact caused on account of this particular COVID pandemic on the financial results of the company. And therefore, such kind of an assessment, although you would make, you may not be in the best position to quantify. So this can be the year of lesser profits. This can be the year of higher losses, but they continue to be reported in a similar manner as to what they have been reporting in the past. There is no particular guideline at this point of time, and I'm very confident that there will not be any further guidelines coming from any accounting standards board or any kind of a moratorium being given to show it separately and differently at this point of time.
Okay. Thanks, Khushroo. That's a very good answer you gave us. So I have one caller who would like to, or rather from the participant who would want to call you directly and ask a question. So Tyag, could you please unmute yourself and ask a question directly to Khushroo?
Hi, Khushroo. I have a question on the governance. Basically, it is for the listed companies. My understanding, if you can tell me, from your suggestion point of view, what are the corporate or the board governance measures required or you recommend to avoid disasters such as things happened in the big infra company or the listed private sector banks? What is your recommendations to avoid such a disasters from the corporate or board governance point of view? And second question, very small, it could be however very naive. Is there any regulatory filings on governance report to any to regulators as well as to the exchanges or listed companies? That's all.
Surely. So I'll answer your second question first. So at the end of the year, at the end of the financial year, the management actually comes out with the corporate governance report, which is then attested either by the auditor, the statutory auditor of the company, or a company secretary in practice. And that actually will list down as to how the corporate governance norms have been adhered to by the company. In the event that there is any kind of an exception where the compliances are not observed or the corporate governance guidelines as regulated by SEBI have not been observed, then those exceptions will be reported into that particular corporate governance report, and the auditor would be, or the company secretary in practice would be presenting it in his or her own report in case, if at all, it's a significant non-compliance. This particular report definitely goes to all the regulators, which includes the stock exchange as part of the annual report. It goes to SEBI and it goes to everybody, including the lenders who have actually provided money to the organization. So that is the second question. Your first question was in relation to what is the kind of framework that should be in place as far as the lending institutions are concerned in terms of the borrowing risk, in terms of the lending risks, correct? The lending risks which normally an institution would be subjected to.
Yeah.
Yes. So more important, I think it's a very, very good question. Look at it in terms of the failures of some of these banks, some of the public sector banks, some of the cooperative banks, some of the banks. What is the major reason of the failure? It is the major reason of the failure is a failure to respect the credit risk assessment and the rigor through which the credit risk needs to be assessed. Banks need to be cognizant of the fact, and this is something which is not significantly coming up in the private sector banks, because private sector banks have been operating with the best levels of controls and with the higher level of controls. And I think a lot of change has happened also in the case of public sector banks as well. But in the past, what we have seen is that if at all your credit risk assessment is not given adequate respect, which it deserves, then definitely the assessment is wrong in terms of knowing the profile of the particular borrower. Thousands of crores can go to that particular borrower. There are indications as well from the public domain and even from your otherwise secret modes to assess what is the performance of these individuals or the corporates who have borrowed the monies. And the banks and the boards need to be cognizant of the fact that that assessment need not be done only at the year end, but there should be a vigil mechanism to make sure that if at all there are any delinquencies or if the performances are not happening or if at all they have failed on any aspects or if at all they are in the news, they need to assess the credibility and the credit assessment of these borrowers at every period of time, which could be on a monthly basis, which could be on a quarterly basis. There have been instances also where even after these borrowers have actually failed to repay, there have been more monies provided to them. And therefore, these kind of credit risk assessments, which have been done in the past 3 years back, 5 years back, 10 years back, do not hold good. So today, if at all the credit risk assessment is not done appropriately, if the collaterals, which basically serve as a security against the amounts lent, or if at all there are immovable properties which is being taken as a security, as a hypothecated or whatever, against the amounts lent, if at all they are not valued on a regular basis, if at all your margin of safety is diminishing, and if the companies or banks or lending institutions are not concerned, then there is definitely a big balloon of risk, ballooning further and further, and which can explode at any point of time. So companies and banks and institutions have started to be very conscious about it. And I think there will be much more stricter regime as far as the credit risk assessment is concerned. And there will be much more disclosures required in the future in terms of the credit risk assessment as well.
All right.
Thank you.
Thank you so much. Thank you.
Thanks, Tyag, and thanks, Khushroo, for a good question. You touched upon cooperative banks, okay? And as you know, recently, I think today, there is a news that RBI is going to be controlling or managing the cooperative banks, just like any other bank. And that is being brought as an ordinance to change the control of cooperative banks. You think it's a good move? And is it the end of politics into cooperative banks?
Definitely, it will not end immediately. I think it will take a little period of time, but I think it's a great move. If you recollect the budget which was being announced, the union budget which was being announced on the 1st of February, at that point of time itself, I think this particular idea was initiated, whereby this entire cooperative bank's governance and supervision and oversight would be vesting with the Reserve Bank of India. It's a great move. Knowing the fact that Reserve Bank of India actually carries out inspections and has a control mechanism on the performance and the operations of the bank of the highest order, cooperative banks definitely will not be in a position now to be a little relaxed on the credit assessments and many other things. So things are going to be changing for the better, I would say. We have had instances of a couple of cooperative banks which have created so much of tension, maybe a year ago or maybe 6 months ago, in terms of defrauding individuals, running away with the money, and the kind of hole that has been created into their balance sheets, which everybody were not in a position to even understand and even think of the magnitude of these particular losses in terms of loans not being repaid or managed in a particular way, which was very orchestrated. So I think Reserve Bank of India coming in will definitely tighten the controls. There will be a fear factor as well. And people will gain more confidence in these cooperative banks once they are very well regulated and have become control conscious. So I think it's a great move and definitely for the better.
Thank you. I have another query, and this is something I like on cybersecurity. I myself am a cyber crime investigator. So cyber attacks are the greatest threats to business. I think. So is it, from a statistical point of view, by 2021, cybercrime damages will be, they say about $6 trillion by 2021. So looks like it will beat illegal trades like drugs and narcotics, the way cyber security attacks are happening. What kind of measures are required to be initiated by the board of directors or the TCWG to safeguard cybersecurity? Is that something that has to be there discussed in every board meeting?
Another good question, and a very relevant one in the current environment. And I would definitely touch upon more from a 30,000 feet perspective, because we are talking more at the board level and at the level of those charged with governance. Now, if you look at today, I'm just giving an example. If you look at today, prime lending financial institutions, look at the data that these institutions have. Look at the data that the payments bank have. Look at the data which an NBFC will have. Look at the data which a credit card company will have. I think millions and millions and millions and hundreds and millions of tens of millions of customers' data which they have, which is being stored in a repository. You're also aware of the fact that the regulations now require that particular repository should be based out of India, and the access should be very, very limited to individuals who have to access the data for the purposes of carrying out these activities in terms of processing of payments, etc. Having said this, what are the controls underlying that particular repository is a matter of concern. And if I'm a member on the board of a bank, or if I'm a member on the board of a financial institution where data is very, very key, and definitely this is, again, I keep on re-emphasizing on financial institutions and banks and other lenders who have such a data available. The banks of late have spent a huge amount of money in cybersecurity, not only at the level in terms of getting the right people to build up those controls, to build up those security measures, to invest into the IT infrastructure, to have the best of software in place, but also engaging some of the best of firms and consultants to do an independent assessment and to even try out, if at all they are in a position to break through the security norms, and sort of whether they can have, after breaking the security norms, the relevant access to the data. So I have seen that the boards are becoming very, very control conscious. Over the last couple of years, there are quite a few cybersecurity reviews being done by these institutions through the assistance and support of consulting firms. And some of these observations which have surfaced in the cybersecurity, talking about some of the defects in the controls or some of the lapses in the operating effectiveness of controls or the design of controls, have been strengthened further to make sure that the cybersecurity system is adequate and is robust. One cannot say, because as much as you would try to do your best in terms of defending your own infrastructure and framework, we should also be mindful of the fact that the people who are actually going to sort of breach into your cybersecurity are more intelligent as well, and you need to be cognizant of the fact, and you need to be ready to make sure that they are not successful as well.
So do you think that the board of directors are aware of cybersecurity, the threats to the business, and is that something that comes up in board meetings regularly?
Yes, it does come up in the board meetings. As I mentioned, it does come up significantly in the board meetings, which are basically lending institutions or institutions who deal in credit cards. There have been instances where these are becoming now regular reviews by independent firms in terms of cybersecurity controls. And yes, there is a scope where some of them are still not up to the mark. And maybe by passage of time and by learning experiences, these individuals and corporates, etc., would also start respecting those cybersecurity norms. But that is definitely the need of the hour.
Thank you. So Khushroo, going further to our discussion quickly, because we're coming to the hour 4 o'clock. Let's discuss about the key management estimates relating to revenue, impairment assessment, investments, and inventory valuations. Who has the prime responsibility to assess the impact of current circumstances on the estimates? That means whatever estimates were done, it doesn't hold any more water because of the pandemic. Who's responsible for evaluating the estimates now?
Fine. So now I think I'm changing my focus more on the financial reporting, since you were talking about estimates. And financial reporting is basically the responsibility of the management of the company. It is the management of the company which takes the responsibility of ensuring that there are proper accounting policies which are in line with the accounting standards, that they are applied consistently over a period of time. And if at all there are any changes in the accounting policies, or if at all there are any changes in the accounting estimates, the management must be in a position to articulate the rationale of such a change. And on account of that particular change, if the impact is material on the financial statements of the current year, then you need to make a disclosure of the impact on the profits or the losses on account of that change in the estimate, if it is material, and the impact, if any, on the future years as well. In the event that this particular impact for the future years is not ascertainable, then there is a disclosure in the financial statements. Now, that is, I'm talking from a disclosure standpoint. But the responsibility will rest with the management in terms of all accounting estimates and judgments. That could be on account of inventory valuation. It could be in relation to stock options. It could be in relation to provision for doubtful debts. It could be in relation to provision for retirement benefits. And there are many estimated useful life of assets. These are accounting judgments and accounting estimates, which under Ind AS, or what we call the Indian version of the IFRS, the management is in a position to take a practical call rather than being guided by certain numbers and specific static numbers. So within a given range, if at all these estimates are aligned to the life of the asset or to that particular accounting function on which the estimate is being used, then these are the responsibilities of the management. These accounting estimates can undergo a change, and therefore they need to be reviewed on a regular basis, at least once in a year. And on account of any change in the circumstances or the change in the business model, or on account of any other change caused on account of any other reason, then they need to be assessed, made necessary changes into the system, and accordingly being reported to the board. The management has a responsibility to take the approval of the audit committee in case of any significant changes in the accounting policy and the accounting estimates. Having said that, being an auditor, I would always like to add a couple of lines in my, since I wear the auditor's hat as well. An auditor has to assess whether there is a correct rationale and there is a real rationale for that particular change in the accounting estimate. Is that particular change warranted? Is the change being given the right effects in the financial statements? And if it is significant, then whether it's being appropriately worded as a disclosure in the financial statements through a note or through any kind of a disclosure. So these are basically accounting changes. Now I'll talk about revenue recognition. There is a new standard called Ind AS 115, which is talking. If you remember, in the earlier days when I had done my CA, and many of us who have passed in the earlier years, we used to have a simple accounting standard called AS9 running into some 10 pages or 12 pages, as compared to an Ind AS 115 on revenue recognition. And the entire landscape of revenue recognition now is very, very different. It is dissected in a manner whereby multiple layers of contracts are actually being taken into consideration, and these multiple layer of revenue contract can be accounted in a different manner, given the fact that the contract may have various obligations. There are various other guidances being given in that particular standard, and one needs to be very cognizant because revenue is a significant component in the financial statements on the revenue in the P&L account. And of course, on the asset side, you would have your assets or other things as well. But revenue is one of the significant components and basically drives your entire financial reporting performance. And therefore, that is something that the management needs to be very much aware of in terms of what the provisions are, and accordingly recognize the revenue in line with the requirements of the standard. And similarly, of course, other things like inventory valuations, etc. Specifically talking about the COVID environment, there have been challenges for the management, for the auditors to do inventory verification. There are various modes by which alternate procedures have been carried out by the auditors to get the comfort on the verification of inventory, on the existence of inventory as on 31st of March and the valuation, etc. It's a very, very detailed, I would say it's a very detailed sort of, I would say, disposition, if at all I have to talk more into the details of it. But it's the management which takes that particular responsibility of accounting estimates and accounting judgments, and that needs to be evaluated by the auditors and to be concurred by the auditors as well.
Thank you, Khushroo. Khushroo, we have actually reached the 4 o'clock. It's actually past. But governance is such an interesting and such a vast topic that I think this 1 hour is really not sufficient. If I can hold you back for another couple of minutes, I can ask you some rapid round questions. You can just say yes or no, or maybe 1 or 2 sentences.
Surely.
Should government be lenient on governance now?
Not at all.
Should TCWG implement a COVID transition team in almost all corporates?
Yes, to the best extent possible.
Should risk management be focused on additional risk and prolonged risk probabilities?
That's correct. Yes, it should be.
Should every company look at business continuity plan, BCP, for pandemic situations?
Top priority, of course.
Health and safety regulations needs to be revisited and implemented strictly?
Absolutely. The buzzword over here is people over profits.
Yes. Migrant laborers, reinstatement and productivity needs a fresh approach.
Very true.
Aggressive and innovative technology to be on every TCW meetings or board meetings?
I would say safe technology. You can have virtual meetings, but the technology has to be safe. You should be ensured of the fact that others are not actually hearing what's happening in the boardroom. So that technology should be of the highest order. And you get excellent indigenous technology these days.
Okay. Should we reinvent salary structure based on merit and what have you delivered, not on, that means variable basic pay and not a fixed basic pay?
Very much, yes.
Okay, maybe controversial. Many may not like it, but that's the silent investor. So that's my last question to you, the silent investor. The silent investor will be at a massive erosion of wealth. How to deal with them?
This I cannot answer in a yes or a no, but
okay.
I think silent investor has to be very mindful of the fact that he should continuously assess the performance of these companies where he has a wealth and exit before the losses keep mounting, and look out for better opportunities. And even if at all there are no further opportunities, at least to invest into those liquid instruments, which will give him some return. Because if at all he's not mindful about further erosion of wealth, he would definitely tend to lose more than what he would lose upon immediate exit. So he needs to be well guided, and he needs to take those conscious calls as well.
Thank you. 2020, a year to be forgotten?
To be remembered, because it gives a different experience.
Okay.
To be remembered.
Thank you. Thank you. Thank you, Khushroo. And I'm sorry I had to hold you back because the subject is such that it is so interesting and so vast. So, ladies and gentlemen, we have come to the end of the show. We've touched a lot of topics. We could not have. It's not possible to cover the governance in 1 hour's time. We touched on the roles of the board of directors, risk management, internal audit, statutory auditors, window dressing, moratorium estimates done and review. We also talked about cyber attacks and many other topics. Khushroo, I want to thank you profusely for coming to the show, spending your 1 hour with us and some more minutes. And it has been very interesting talk. And we would love to invite you once again and at some other good opportunity moment. And thank you once again for coming and telling us so much about governance.
Thank you, KK, and thank you to all the organizers who actually invited me and gave me this opportunity of presenting my thoughts on corporate governance, which is something very dear to me. And I would wish everybody best of health, stay safe, and thank you once again for the opportunity.
Thank you.
Thank you.